faced with asking the most difficult questions about life, our society, and the world economy at large. The answers we seek are inextricably linked to the commitments we make and the actions we take. At the Institute of Certified Chartered Economists, ICCE, our commitment is to raise professional economists with the highest ethical standards through quality education and collaborative learning. Our global network of economists professionals are challenging conventional wisdom, advancing ideas, and contributing to the transformational agenda of the world economy. ICCE is raising economists globally, and you too can be one. Make the smart choice and become an ICCE charter holder today. Join the ICCE today and let's measure up. www.charteredeconomists.org.
So I'm just sharing my screen to do this short presentation about the ICCE so that you'll be able to understand who we are and what we do, and of course, why we're having this webinar. So the ICCE stands for the Institute of Certified Chartered Economists. So it's a leading qualification for today and tomorrow's economists. So we are membership-based professional qualification for people or individuals who are aspiring to be economists, or people who are already working or practicing economists and they want to belong to a professional association that gives them the opportunity to continuously learn, evolve, and of course appreciate the new trends that are happening economically, globally as well. So that is what the ICCE is. And of course, we have a vision of raising economics professionals with the highest ethical standards through quality education and collaborative learning. So we offer our members the opportunity to collaborate, to share ideas, to learn, and of course, through the ICCE charter, you get to get deeper into economics knowledge. So here we have our leadership. So we have individuals from Europe, from Asia, Africa, who are part of the leadership of the ICCE. So we have Dr. Fran Luthier, who is a former World Bank VP and currently the CEO of Southbridge Investment. We have Professor H.K. Pradhan from SLRI in India. We have Professor Lima Mukherjee, also from India University of Engineering and Management from Calcutta. Dr. Mustafa Ibn Buama, Associate Professor of Economics, University of New Brunswick. We have all these amazing professionals who are serving as the leadership of the ICCE. And of course, you can see in there, we have our very own speaker for today's webinar, which of course in due time, we introduce her, Danley Marcia, as a Chief Economist with Dutch Bank and for Sub-Saharan Africa, Nigeria, to be specific. So she is part of the International Board of Standards of the ICCE. So in due time, we'll introduce her to you. So for membership, what we are saying that the minimum requirements you need to be able to meet our membership requirements is that you need to be at least have a bachelor's degree or enrolled in your first year at a bachelor's degree level. So if you are in this position, then of course you qualify to apply to become a member of the ICCE. And of course, in order to ensure that we maintain standards, as you become a member of the ICCE, you are required to undergo some mandatory examinations, which can come in the form of either you are going to get exempted from some of the papers based on your previous qualification, or you have to start from the beginning until you reach the final specialization level. And so the examinations is done via computer-based testing. So exams is accessible to you anywhere you are in the world. So there's no barrier as to how you can be able to access and take your ICCE exams. Our pass mark is 50% across all papers. The curriculum is structured in 4 levels. So we have level 1, level 2, level 3, and then we have the final level, which is specialization. So in each level, there are a certain number of papers that we offer that you have to take. You need to write these papers and pass them by reaching the 50% mark, and then you can move on to the next level. So all this information are available on our website. In the course of the conversation, I'll put the relevant links in the chat box here on the Zoom platform. So you can visit these links so that you can get the more detailed information on all these papers. Of course, I also put my email address there, so in case you want to reach out to me directly, I'll be more than glad to assist you. So we have professional specialization level. I played a video earlier. So we have petroleum economists, energy economists, health economists, managerial, marine, labor, industrial, and you have financial economy. So in any of these areas, professional areas, you can specialize in them. And of course, you can specialize in multiple areas as well. So there are fees that are available. I'll send a link in the chat box. Of course, you also understand the importance of easing the financial burdens of our learners. So in this case, we have scholarship opportunities that are made available to all our learners. So if you can visit the website of the ICCE, which I'll share with you, you will see that we are offering 4 scholarship schemes, each detailing the requirement that you need to meet before you can apply for such scholarship. So we have women-focused scholarship, we have faculty scholarship, we have media professional scholarship, and of course, we have the future economic scholarship. So these are the 4 scholarship schemes that we are offering to our members. So in the event that you want to be a part of the ICCE, you will have to visit our website. There are more information there. I will share relevant links with you, and then you can be part of it. Of course, as an organization, we also are assisting governments through the ICCE advisory. So we are offering advisory services in various areas, i.e. markets, entry researches, and advisory bureau services. We have ESG and impact investing advisory, foreign direct investment, policies and regulations that we can help government to put together. So in the case that your organization that represents are looking for economists and consultants to help them in any of these areas, please, you'll be able to reach out to the ICC, and we'll be very much glad to assist you in this regard. So thank you very much for giving me the audience. And so we are coming back to the main reason why we are here today for today's webinar. So I'll take the opportunity. I'll, of course, first introduce the moderator for today. He will take over and, of course, run us through the next sessions. And just a quick announcement, those of you who are familiar with the Zoom platform, we have the Q&A button that is there. So here, what we are trying to say is that we would like everyone to be part of the conversation you're going to have here today. So in the case that you have any question regarding today's topic, or when it happens during the presentation of our main speaker, you are allowed to send these questions using the Q&A button, and we'll be able to, the speaker will speak to those questions. So please, we would like you to be part of the conversation. So do well to send in your questions as you have them, and then we'll be very much happy. At this point, my job is almost done. I will come in later when we are done with the entire session. It will be an honor for me to introduce to you today's moderator in the person of Dr. Evans Gia, who is a chartered financial economist. He's a lecturer of one of the leading universities here in Ghana, as well as an author. Dr. Evans, please, you may take over now. Thank you.
Thank you so much, Paul. That was an excellent presentation. And a very good afternoon from here in Ghana, and good morning to all of you. Bonjour, salam alaikum to everybody, and it's a privilege to come your way. So today we actually going to have a wonderful time with Daniele Masia, and forgive me for the pronunciation. I'm sure when she comes up, she'll correct me with the right way to pronounce her name. So basically, we'll just look first, before I do the introduction of our main speaker today, it's good we have a look at the topic. So the main topic, as you've all seen, is all about the economies in recovery in Sub-Saharan Africa, and the outlook is basically for 2022. Currently, the IMF has done some projections, and according to the IMF, there is a 6% from 2020 to 2021. The projection for the growth is around 6%. That's globally, and also 4.4% globally for 2022. In the event of Africa, it is projected, Sub-Saharan Africa to be specific, it is expected to grow by 3.7% as 2021 and 3.8% in 2022. So the region is expected to rebound. However, growth will vary across countries, and the road to recovery may also be very long and difficult because we are in a asymmetrical kind of situation where some have the COVID under control, whilst others are still having a lot of infections, some are returning to normalcy, and others also have challenges here and there. So today, the focus here is how we're going to look at this volatile, ambiguous, also uncertain, and how we're going to look at this complex environment and how most of these economists can recover and get back on their feet. What are some of the solutions? What are some of the options? So like Paul just made mention, what we'll do is that you have the Q&A button there. You can drop any question at any time. Once we are done, we would give you the opportunity to read some of your questions, and some of you will call upon you to contribute. So without much ado, I will quickly introduce our speaker for today. So Daniele Masia is actually a chief economist from Deutsche Bank. She's actually a practicing economist, and we all know Deutsche Bank is a leading global investment bank. And she covers the South African economy and other Sub-Saharan African countries like Nigeria. So during her term at Deutsche Bank, Johannesburg, she was co-head of the South African equities research team, which ranked highly in domestic and institutional investor surveys. So she started her career in 2004 as a retail credit analyst at Nedbank before she moved to the Treasury division in 2005, where her love for capital markets actually began. In 2006, she joined Standard Bank Group and became head of economic research in 2007. So Daniele graduated from the University of Johannesburg, a top-notch university, in 2007 with a master's in financial economics. And Daniele is also a member of ICCE. So without much ado, Daniela, the floor is all yours, and we are ready to listen to you.
Thank you very much, Dr. Evans, for that introduction. I really do appreciate it. And thank you also to Paul for this opportunity today to share some thoughts around the outlook for our region. As Dr. Evans had highlighted to you, I do specialize in South Africa. So please do bear with me if some of my views do seem from afar. I haven't visited any of these countries yet. My coverage of Ghana and Nigeria had pretty much started during COVID, which you all would appreciate has been a very challenging time for most of us. So without further ado, I am going to share my screen to talk to some of the slides. And as I've mentioned, please do feel free to actually engage if you do have any questions for myself or even for the panel, who I know are also experts in the region. So I am definitely going to call a friend today. But for what it's worth, I hope you can see the screen. I'm summarizing here what is a fairly challenging backdrop for Sub-Saharan Africa. Dr. Evans, can you please just confirm whether you can see my screen?
No, it's not.
It's not showing. Let's see now. Anyway, I think I might have to click on. Here we go.
Yes.
Right. Thank you very much. So, yeah, the outlook for the region is quite frankly a tricky one. As you all know, Sub-Saharan Africa and Africa more at large has got its own challenges. It's known for regions that obviously had very high growth rates prior to the pandemic. And I think the hit from the COVID pandemic has obviously been disproportionate. We've seen how statistics corroborate divergent growth rates in many of the developed markets. They've reached their pre-pandemic highs pretty much last year already. Some emerging markets have also hit their pre-pandemic levels more or less in the second quarter of last year. And for what it's worth, I think looking at Africa through the lenses of where they specialize, it probably means that many of these countries will probably only start to get to see some of their pre-pandemic levels next year or perhaps 2 years from now. While the inequality thing is obviously quite a big challenge, I think it is going to lead to a significant pressure for many governments to reform. And I think the reform momentum has obviously been interrupted in many respects by the onslaught of the pandemic, whether it is through this form of the impact that it has had on oil-sensitive countries like Nigeria, Angola, and how tourism-sensitive countries obviously has also been negatively affected. I draw from the IMF the conclusion that it's really more the diversified economies that will probably reach their pre-pandemic state somewhat quicker. And I think Ghana, which I'll be discussing with you today, is a perfect example of this, but not with significant headwinds. It brings me to the next point, the fiscal trilemma. I mean, we all get to understand that the balance sheets of many African countries are hamstrung by the fact that they've got very low tax revenue mobilization. And this is a big issue currently because the pandemic now more than ever will raise the developmental needs of these countries. We also have no idea of how big permanent scarring may be. So permanent scarring reflecting here to how much tax revenue has actually been lost, perhaps through the exit of some companies, through labor markets, and whether governments will be able to really balance a lot of these trade-offs, I think is going to label the speed of this recovery in Africa, in my opinion. Of course, inflation is a key point, and globally we have seen a rapid tightening of rate hike expectations. Emerging markets are already well underway there. But for what it's worth, I mean, the point is that Africa has actually had very high inflation rates going into the pandemic. The question is, can they navigate lower inflation throughout this year, now that we are seeing, of course, again, renewed escalation in oil prices, food prices. And so this does actually create extra pressure for these countries to normalize against all of the challenges that we currently have mentioned. If that's not, enough, we've got, the pandemic also fast-tracked, I suppose, climate change agenda. And if anything, this is coming at a time, of course, when Africa might be reeling really from the likes of fuel subsidies that are still in place in many countries, as you are aware, and very difficult to remove that, be it politically speaking. Nigeria, a classic example of this. But to be fair, this is currently the best stage for countries to demonstrate their capacity to reform. Because as you would be aware or might have picked up, but during the COP Finance climate agreements, it's emerged that there's almost $9 trillion on the stage waiting there for countries to grab. Only those countries that have got really good projects to decommission their baseload capacity, whether it is coal-based, such as in the case of South Africa. There is a stage there for many countries to compete at. However, it does seem at this point in time that Sub-Saharan Africa might lag. There's massive gaps currently in adopting what would be a very costly shift for Sub-Saharan Africa. There are estimates of between 30 to $50 billion that would be needed every single year. That's 2 to 3% of GDP. That would be needed to ready the African transition in this whole global climate change shift. And I think what is really important to notify is that, yes, Sub-Saharan Africa might not be the biggest greenhouse gas emitter, but it is the most vulnerable in terms of climate swings. I've read somewhere that a third of the world's droughts occur in this region. And so it is absolutely of essence that the Sub-Saharan Africa governments come together with some form, I would say, of really innovative, perhaps even non-traditional ways to get themselves into the carbon pricing mechanism, so how they can utilize some of their resources, be it the vast resource base that they currently have, forestry, for example, to map out a cleaner and clearer structure. And then finally, of course, we know that the Sub-Saharan Africa, or the Africa region at large, is undergoing clearly more a shift to intra-regional trade with the African Free Trade Finance Agreement that's underway. And it does create significant amounts of opportunity and investment, which I think will help with the long-term path of the region. But without further ado, let me start drilling into some of the regions that I cover, and also juxtaposing some of the IMF forecasts that you might see in front of you. So broadly speaking, yes, Dr. Evans highlighted that it's going to be a fairly robust growth environment, even if not quite matching pre-pandemic levels, but there will be a multiple speed of recovery here. I think when we look at, for example, Nigeria's growth forecast, and these would be kind of the levels that I'm looking at, I'm probably a little bit more optimistic than some forecasts out there for Nigeria this year, being above 3%. Many of those numbers are sitting at below, possibly slowing. And I think really where my enthusiasm comes from is just broadly the resilience that I've seen in demand of this country. And notwithstanding the fact that world production has been under significant duress, there will be some base effects, even if we normalize production at current levels. If we assume the January output levels sustained for the rest of the year, there will be a positive base effect on Nigeria's growth rate this year, and then that potentially slows going into 2023. Ghana, I must say, another surprise. I was quite reserved about Ghana's growth rates. I've now jacked it up to about 4.9% for 2021. And more broadly, been surprised again by what has been far more resilient services in the third quarter of last year. And this also has propelled me to move towards above 6% growth rate. So somewhat more robust than what its government predicts. I'll spend some time on that, but of course we all know that Ghana is not without its challenges, given where we currently see inflation and fiscal risks. So there's a couple of ideas here really around different and variables that we look at as financial market economists. I think what is clearly a standout difference is that government debt in the whole region pretty much is expected to ease. And this is due to the fact that some economies are capable of consolidating faster. Both Ghana and Nigeria will see upward pressure on their debt rates. This is in part due to FX valuations on their debt, their FX debt, and what is also exceptionally high interest costs. In many cases, you will find that when you start talking like 50% of expenditure that is clearly earmarked for interest costs, it really does start to crowd out your developmental needs. And I think this is some of the challenges that we are aware of that Ghana would be facing this year. Reserves is quite a big issue, not central only to Nigeria in terms of how it can sustain the level of the Naira this year. It will be a big debate. I think the FX rate in last year was dubbed to be one that would have been devalued. We were luckily quite on top of things here last year, given the fact that the oil market recovery helped to cement a lower current account for the Nigerian economy. And as a consequence also of the Eurobond issuances and the SDR allocations, that helped give Nigeria a massive boost to its reserves. However, this year, I think clinging on to a $40 billion level is becoming probably a lot more challenging. And I'll share a couple of ideas there with you. But I do think, given the fact that we are entering a world of tightening global financial conditions. So this is as we are seeing the Fed, the ECB even now accelerating its own rate path, it's going to make it more difficult for countries with negative real rates to compete. And if you look then at the inflation rates in these economies, very hard to see how they can remain competitive when it comes to foreign financial flows. So against all of this, I would say that yes, there is a lot of opportunity for Nigeria. Of course, one of the big issues that we have been alerted to this year was the fact that we probably would have moved away from fuel subsidies. That now recently has been extended. And previously, the outlook was attached to a floating exchange rate probability that would have been linked to the Dangote refinery coming on stream, since that would have reduced some of the demand for dollars, and in so doing, helping the central bank to start reducing the managed float that it has. I think it's very clear that this will be a very difficult path to follow, especially now that we have seen an extension of the fuel subsidies, and again, the elections being a perfect reason why this would have probably failed in the first place. But in front of you, just a quick little summary of how we see Nigeria's growth rate. So you might find these the contributions that we see from an economic growth perspective. The base effects are going to be out of the way now, following what was quite a steep recovery in the final half of last year. And we still find that more broadly, services will be the key driver of growth here, and then industry, and then finally, in part of that, you'll have the oil market recovery adding a couple of basis points to that growth rate. I suppose that for us, what is quite clear though, is that if we actually saw a return to oil production that is more in line with the quotas that OPEC agreement has allowed Nigeria to operate at, then I would say we can very easily see Nigeria's growth rate moving to 4%. So a whole percentage point larger than what we are currently predicting. But the fact that there has been this significant drop in oil production relative to the OPEC quota does suggest to you that there's been a lot of opportunities here that's been squandered, partly through the insecurity issues, the vandalism that's happened, the smuggling that still happens around oil. And to get this market to really grow and to have the petroleum industry bill really benefit the industry at large through the value chain, I think there's going to be a lot of groundwork that needs to come through in terms of limiting what really has been quite a big destructive knock for the oil economy last year. So we count cumulatively relative to the OPEC quotas that there's almost been about 15.5 million barrels lost of oil production that could have generated up to $4 billion of revenue receipts. But besides that, if we now just shift out of the oil economy and we look a little bit more about how high frequency activity has evolved in Nigeria, then this is the kind of thing that really makes me sit up. I'm covering South Africa, and I know how difficult it has been for the South African economy to transgress and move over the hurdles of COVID. But when you look here at what has been typical Google trends on average mobility that has happened in Nigeria, then the second half of the year already last year had gave in quite significant activity. It also, from a retail perspective, the way that I look at things is that we are quite data constrained, and from afar, it's very hard from my perspective, not being on the ground, to have really good understanding of how strong retail activity is. I mean, this is still very much the crux and the bane of most countries' growth rates. But what I thought was a fascinating read-through is when you use this very same mobility data and you look at the differences here between grocery and pharmacy mobility. So this is above zero baseline, means that Nigeria has moved to above pre-pandemic levels in terms of their mobility to grocery and pharma centers. And then when you look at retail and recreation, this is my read-through that this is more the affluent spender and the appetite, the consumer confidence that has come through. And it seems that very late last year, this gap started closing of this consumer entering the market. So we had a very strong recovery in the third quarter as it is in terms of growth. And it does look like the pace, even if we just use the pace of activity here, suggests to me that the fourth quarter is likely to give another lift for this year's growth rate. Remember the massive carryover effects that you get for the following year from having a very strong end to the previous year's growth rate. So as I've mentioned, I think what sets Sub-Saharan Africa apart from many of these other inflation cycles that are coming through in the world is that it went into COVID with already high and rising inflation, specifically driven by food. Here is Nigeria's case. And we've had obviously quite a big turnaround already with, of course, a lot of uncertainty. We've got uncertainty about electricity costs, about gas prices. We have massive uncertainty about transport. Obviously now the subsidy has been retained, but we're still not quite out of the woods with regard to how FX pressure really comes through in the Nigerian economy. So what you find on the right-hand side is just the sequential month-on-month inflation rates for food. You've got headline inflation, and then you've got what I've used is sort of the parallel FX rate, utilizing from the middle of last year quite a lot of proxies, since we no longer have a very clear idea of what's happening in the Bureau de Change space. But it does seem from a year-on-year perspective that pressure in the parallel market side has abated. And we know that this is where a lot of retailers operate at. But inflation really is going to remain high so long as there's uncertainty about the FX direction. And so again, what I've done to try and look at how this affects inflation expectations is to do a simple exercise looking at how many times do people Google the Naira. And this is obvious, you know, from a remittance perspective, where Nigerians in the diaspora might be looking at sending money home. There might be fears of devaluation, but we've often find that Google trends, the higher the spike, the more activity around searches had occurred during these times, notwithstanding even the fact that there were quite a lot of uncertainty in Google or uncertainty around the currency. The currency had remained unchanged for a very long time period until we started going into the pandemic. And then we started seeing a rising concern around Naira direction, perhaps not as severe as in previous years, but then subsequently, the Naira obviously got devalued, and we're now sitting at a level where there is still a substantial level, probably 40-odd%, sometimes people are saying even 50% overvaluation. Notwithstanding that, if you look then at these expectations or these uncertainties, the blue line that depicts the searches on Google, which is a fancy proxy really for FX uncertainty, if you will, it's quite interesting that there has been a significant correlation with headline CPI relative to when these spikes have emerged. So it's almost been a bit of a leading indicator that something is about to change and that there is some level of direction also now coming through in higher inflation momentum in Nigeria. So I do think that we are not out of the woods with regards to how inflation pressure will evolve in Nigeria. But for now, I would say perhaps the immediate need for devaluation has probably lessened, given the fact that we have seen foreign exchange reserves normalize, which is more closer to the $40 billion. More recently, it's now started dropping. It's now back below 40 billion. Now, my take is that often the pressure to devalue the currency doesn't come from the parallel market. Most people actually think it's the pressure on the parallel market rates that forces a devaluation. But if anything, it's actually the fact that liquidity gets scarcer. And so the FX reserve level is really the one at the center that dictates when the central bank needs to move. And I have found historically that any levels from around $38 billion starts to place pressure on liquidity because of swap agreements that underlie FX reserves. And often we don't get to understand just how big the FX backlogs are as well. And so to my mind, I would really say that there is a moderate risk that the central bank would have to gradually devalue the Naira this year, potentially next year as well. And I'm not talking here of 7-odd%, I'm talking here of about 2.5%, perhaps 3%, to allow for very little inflation risk. And the reason why is quite convoluted. I mean, we look at FX reserves, and to back out what FX reserves will be doing, we have to look at the current account and how that current account is funded. And this is what one finds on the right-hand side of the screen, is the breakdown of the current account deficit. So for what it's worth, the trade balance that has always been in deficit over the last couple of years due to the oil slump has now pulled the current account back into a surplus position. But we know how vulnerable the current account is also to travel resuming, business travel, and so the biggest share of deficits usually come when activity normalizes and Nigerians are allowed to travel again. So the question really comes back to how much this level will be sustained. And this makes the Dangote refinery also quite an important one in the bigger scheme of things, because not only can it reduce dollar supply or demand rather in terms of the import requirements, but it can also lead to further exports. And that's helping again to cement what really could be a better current account balance, and therefore helping the FX reserves. But on the flip side, when you look at how the funding mix has gone, then the improvement in the deficit has actually more recently led to a deterioration in capital flows. So foreigners are not actively purchasing Nigeria portfolios, and as a consequence, we face quite a lot of risks around the backlog of FX, which estimates are that there is up to $5 billion of backlog, be it from corporates or combined with foreign portfolio investors. So the Naira will be a consistent topic of debate this year, at least on the markets and the investors that I speak to. And from a flow of funds perspective, I think they can really tick the boxes on 3 of the elements that really drive Naira flows. The Africa Free Continental Trade Agreement would be a positive element, but it is a longer term development. We also have services exports that should start recovering, given the recovery in banks. We also have imports that likely would be lent a helping hand with regard to the refinery, as I've mentioned. But Nigeria still has a very large saturation of consumption imports. And So that really does remain one where import substitution is necessary. Remittances is seasonal, as I've said, and as we go around the wheel towards external debt and capital flows, the real question comes through typical funding and longer term funding and developmental funding still very much hinge on the ability to reform where there is a lot of question marks, notwithstanding some of the massive improvements that has been made with regard to, for example, the Petroleum Industry Development Bill. But it certainly does feel like there's been a bit of a step back that's been taken more recently with the scrapping of the fuel subsidy that's now been adopted again. So let's go to Ghana quickly. What I really find really interesting is that it reminds me quite a lot about South Africa, and perhaps in the early stages of South Africa about 40 odd years ago. I shouldn't be giving my age away here, but still, it is one of the countries where there is a really well-diverse mix between services, mining, manufacturing, and then of course agriculture, where the bulk of the informal sectors are operating. Even when you look at the split of trade, so I point this out because I find that in the global environment currently, the commodity cycle has not shifted as negatively as I think we have all feared. And I think what is quite fascinating, if you were to devise a quick terms of trade proxy, then the fact that they're only importing around 20%, let's say, gas and oil, but have a very diverse mix of gold, cocoa, forestry, wood, even other export mixes that are in the commodity cycle, the terms of trade support for Ghana is still very much a favorable one. So when it comes to the growth outlook, I originally had a 2.4% for last year. The third quarter last year completely surprised to the upside. And so this year we've got a 6.6% growth rate. I would say of about 80 basis points, call it a full percentage point, is coming from the oil recovery, where there is still a lot of contention, whether this really would be as strong this year. But the bulk of growth, again, is services denominated. I do have a view, though, that the very sharp destruction that happened in the manufacturing sector, so if you look at the manufacturing growth rate year on year, is quite correlated to what happens to the credit cycle and how consumers spend, but also how corporates fund themselves. And so we find here that the rate of change in credit in the economy is starting to improve, and it tends to lead industrial cycle by about 2 quarters. So it does suggest to me that perhaps the early parts of this year could be fairly favorable for the manufacturing sector. But then there is still what we know is the global issues around supply shortages, the work backlog. So here we look at the composite PMI index for a gauge of just how supply shortages globally has affected Ghana. But again, what is quite significant is that the overall indices remain above 50, which is a positive growth indicator. And it's clearly also a factor that the Stanbic and markets that does actually collate this data suggests that Ghana has been very able or capable of increasing capacity and also increasing staff to make sure that these work backlogs are not such a deterrent to activity. So when you look therefore at the overall cost base, I suppose these are input costs, these are purchase prices, input prices have recently started falling somewhat. There is a reasonable idea here that margins are starting to recover. So if they don't add more to retail prices, and I think there are adequate margins from what I can gather on the retail side, then this recovery, to my mind, will remain fairly well supported. Of course, these are inflation rates that we haven't seen in many years. And so here you're looking at producer price inflation, This is then split into the various industries that comprise the total index. But quite frankly, it is one where manufacturing prices are starting to rise quite significantly. Within that, on the right-hand side here, it's partly because of what was a significant escalation in fuel prices. So, you know, almost 60% year-on-year refined fuel prices. The CD, as I said, is under significant pressure, more from a fiscal perspective. And so it does raise the import costs for consumers. And so more starts to question whether inflation in Ghana is not going to remain stickier than what we currently predict. I was quite shocked today that the inflation rate came out at 13.9%. We thought that that would probably have been the scenario had transport fares adjusted by 40% as was originally planned. But it does seem that there's therefore more to come with transport costs going to adjust by that magnitude from February onwards. And that does leave us questioning whether it's going to be a smooth sailing year for Ghana. Of course, as you might be aware, Moody's had downgraded the credit over the weekend, actually on Friday. And as it stands, the fiscal challenges has obviously opened up a lot of problems for the sovereign because in the final half of last year, it's become more difficult to tap the external funding market, and the government also relies for more than half of its funding from external sources. So whether the pandemic had created this massive impact on the fiscal deficit, you know, is undisputed. There's nothing that can be done from that. But the question is this consolidation in the fiscal finances seem to be too slow. And this is what the market finds very difficult, given the fact that there's been a lot of uncertainty around how revenue is going to be mobilized. So when you look at the overall level of revenue that's been sort of on decline, the target is 20% for this year. And it's quite an aggressive target. I think half of being able to reach that target would very much depend on whether they can accelerate or implement the e-levy, and also whether there is the ability to actually pass through the discount or scrapping of discounts on import benchmark pricing. So the actual mechanism that determines import duties. Because this will be inflationary again, but it is a means to expand the revenue net. For me, having seen this movie before in South Africa, the real issue is actually expenditure. And I think that this will be and has been a focus point for government. I think the only issue is when you look now at the impact on the fiscal deficit is that the market thinks that the guidelines and the latest budget trajectory is too steep. And I would also agree that I think cutting expenditures by up to 20% might seem quite aggressive, but it's not impossible given that in 2016, going back to the fact that there was a very similar type of need for consolidation, this incumbent government managed to cut back by nearly 3.5%. So it can do this, however, in an environment of rising global rates, it may be a lot more difficult to get this done. So you cannot afford to miss a step on expenditure reduction. So I've just included a chart here that very briefly shows the share of expenditure, and you can see and appreciate that interest payments form the bulk of the share in terms of total expenditure. And so it remains very vulnerable to the progress or perhaps the lack of it this year. So I think we remain very intrigued by the growth environment, and I think that Ghana will be able to transcend this really tricky mix of cutting back or consolidating somewhat faster. But I think as well, one has to know realistically it might be very challenging in the current environment to do so quite rapidly. I'm going to spend very quickly some time on South Africa's growth rates. It's in a very different environment. I mean, it's also been a very low growth environment. But what is interesting is that, you know, here we look at pre-pandemic levels. We look at the trend growth that South Africa went on prior to hitting the pandemic. And we look at the current rate of recovery, where we'll probably only hit pre-pandemic levels more or less by, call it, the second quarter of this year. But what is interesting is that I think the trend growth in South Africa has improved somewhat. It's mostly due to the fact that we've had the helping hand of this robust commodity cycle. In this chart, I very quickly show that it probably takes about 2 years for a commodity cycle or positive commodity shock, so these are the gray bars, to spill over into the rest of the economy. So the rest of the economy here being the red line that accounts for mostly services, it takes approximately 2 years. Now, we've already seen commodity producers and extraction sector recovering quite sharply to above trend. And I think we are more or less there now, where the services side of the economy is likely to augment it. And that helps a little bit to explain why I'm a little bit more upbeat about the outlook for the South African economy. There's also a very different shift, and I don't want to go too much into this detail, but it's very important in understanding South Africa to understand where we come from. We had obviously also been in an environment where 2009 was the last big financial crisis. The way that South Africa got out of the crisis was to raise government employment, wages, and this really spiraled where the private sector consistently had to match it. But in the biggest sphere of corruption, of a deteriorating electricity supply, what happened was that the mix of South Africa's income, so if you take the income pie and you split it into the share that went to labor, the share that went to capital or profits, that really went in opposite directions. So South Africa comes from an environment where it's starting off a very high base with regards to the share that corporates are spending on employment, and very little in terms of what is available for what is the most important, and that is capital investment. But it also explains why South Africa's potential growth had collapsed, because very little, in fact, the right-hand side of the chart shows to you how private sector capex just really got run down over the cycle and obviously got exacerbated by the pandemic. So we have seen a turning point here where the pandemic unfortunately had resulted in what has been a significant cutback in the wage share through increased job losses, but it has opened up corporate profit margins to a large extent. So the issue here being that South Africa might actually see an environment where capex cycle might be revived in this business cycle, and the wage share, which is also a proxy for labor costs, unit labor costs, or inflation, goes the opposite direction to what is seen in many parts of the world. In many parts of the world, these roles were reversed. The capital share was rising, the labor shares were falling, inflation was low for a very long time, and now they're seeing the reverse. And this is something that I think actually would stand South Africa in good stead when it comes to explaining why inflation remains relatively low compared to other emerging markets. So finally, I just want to end off with saying that what is fascinating is that most of you would have probably heard about South Africa's electricity brownouts. We call it load shedding. And the issue here is that we've had the highest share of unallocated electricity production or load shedding on record last year. But it comes at a time where our industry have actually reported that demand has become less restrictive. It's also the first time that we actually see on survey data that the manufacturing sector has decided to start employing, so adding more labor to the pool, something we haven't seen going back in more than a decade. And so it tells me that with all of the spillover effects of the commodity cycle into growth, that perhaps the manufacturing sector is on a better footing with regard to the sensitivity of the electricity cycle. I think there's this notion that South Africa cannot grow, and I know that it is constrained. But I also think that there's been so much investment happening in parallel to recent years' crisis on the electricity front that now stands many of the sectors in good stead to respond to the cycle that it's dealt with. Politically, the last sort of line I just want to show, constraints are still high, and it really just stems about reform momentum. I finally just want to share a slide on inflation. So South Africa's inflation is coming down, and we really do think that it means that our own Reserve Bank would be able to cut, or rather to hike rates more gradually, not having to keep in lockstep with the Fed. And one thing that has helped South Africa with regard to better, I would say, policy mix is the fact that when you look at our budget trajectory, the red shaded area is just how much fiscal slippage has been dominant in the previous 5 years. When you look at 2021, the fact that it's broken out of this range and it's much narrower, in other words, we've got 3 months to go, and yet there is only 75%, or call it 70% of the budget being reached. I think there is scope that South Africa's fiscal side or cycle would be recovering, helping to reduce some of this risk premium that's been built up in our bond market. And so what is still a challenging environment for South Africa, notwithstanding all the risks that are out there, is that I think there is a very interesting tipping point happening in South Africa, but structural reform will remain the name of the game, as it is for many of these other countries that I have spoken to. So with that, thank you for joining. I'll see if there's any questions that have popped up on the screen, and please feel free to share your thoughts. Maybe I've got rose-colored glasses on my side, so it would be lovely to hear from you.
Thank you so much, Danielle. I mean, it was such an excellent presentation, and I think it's been very insightful for most of us. I think it was quite succinct. It was quite detailed. The data that you shared, projections, everything was quite fantastic. So I think you're a natural lecturer. So one day you should consider that. So it was a good one. There are some few questions, but before that, we have just a quick one. We have Professor H.K. Pradhan who wants to make a comment before I come with the questions that are in for you.
Many thanks.
Prof, if you are there, you...
Yes, thank you. Thank you, Danley. This is Professor Pradhan, and it was an excellent talk with enormous information data. And I personally, having worked in Nigeria and Kenya on debt management, possibly around a decade ago, so I remember how vulnerable the debt situation can be. And so I would just like to draw your attention to mostly the debt side of. Now, it's good to know that there are areas where the exports probably would have picked up because of global growth in trade, possibly yes, and some developments happened in foreign exchange earnings. But I think the external situations remain critical. Oil prices now going up, and once the inflation goes up, there will be pressure on currency again coming up. And so the most critical would be the debt. and its servicing. With devaluation, the debt servicing become costly, and the debt itself, the levels will go up. It's already up during the pandemic because of the government budgetary expansion. And so what I see is that possibility of the sovereign, the sub-sovereign, as well as the parastatal debt, and all of them can really balloon, needing the government to have a very large fiscal space, and it would impact again on debt markets and interest rates. And it's no different. Even in India, the similar story. So therefore, unless an external environment of financing is not as smooth as they used to be 2 decades ago, or there are not many debt waivers or debt provisioning. So countries have to more inward looking and manage the debt primarily using domestic mechanism like financing, domestic financing or domestic rollover or maturity transformation buybacks, which is whatever the debt management techniques they will have to do a little bit to ease the burden on fiscal. And I think the entire burden is now coming to be on fiscal side, because the monetary policies have almost reached the limit. The interest rate reductions have happened, and the liquidity has already reached where inflation is shooting up, or at least triggering. So therefore, I think the burden has to. So how do you see going forward from Africa? And I think you have very, very interesting point you observed. How do you see the debt situations turning out to be?
With reference to Ghana, or with reference to Nigeria, or just more broadly speaking?
I mean, it would be, of course, interesting if you could give some insight to the Africa as a whole, generally, what is the thinking now? But otherwise, the Ghana or Nigeria also would be okay. Yeah.
All right. So yeah, I think you've highlighted what the real problem is that you are sitting with almost a virtuous circle in the debt mechanics. So the global environment may help the resource-intensive economies to generate higher export returns, but at the same time, if expenditures remain high in this environment with interest costs moving up, it crowds out the ability to actually stabilize debt. And I think you've managed to pin it very clearly. Nigeria's problem, for example, I mean, they've got very low external debt, or very low debt in its entirety. But the fact that Nigeria, well, the Naira devaluation or past or future devaluations can actually raise the debt stock just from a valuation perspective, does make credit risk somewhat more alarming, or something that I think raises red flags for investors. I think the cost of consolidation is actually lower if looked at from an expenditure side. And it sounds really counterproductive, because many countries need governments to spend. But, when I look broad brush at the region, I still think that there is a significant amount of expenditure that goes into current expenditure, and that's consumption-based. That's not growth-enhancing expenditure. And in many respects, the consolidation that often gets made tends to happen in the CapEx budgets, which is not ideal. And I would appreciate that in many respects, South Africa is a very good case in point, that the risk is when compensation budgets get too big, it's very difficult to actually run them down or wind them down. And this is something that I think will be South Africa's biggest test, is whether the proposed expenditure cuts on the wage bill will allow for the government to actually consolidate its debt somewhat faster. At this point in time, South Africa is a lucky beneficiary because the commodity cycle led to higher revenue growth. But that's not a clear gain for Nigeria. That obviously saps its revenue gains through the PMS subsidies that really neutralizes the impact of oil on its revenue. So I think that given the fact that there's always massive demand for sovereign debt coming out of Africa, when I speak to investors, there's clear appetite for it. The biggest thing is therefore that I think expenditure-led consolidation will be rewarded through lower interest costs, or at least capping the growth in interest costs, because that is where most of the problems lie when revenue mobilization is one that really only comes from when you grow and reform the country.
Absolutely.
So it's going to take a lot of these countries the long haul, I think, to get structural reform and capex as their center of the growth rates or development plans, and they all are. I mean, Nigeria's got great plans, Ghana has got great plans, but it comes back to implementation, and South Africa is lumped into that as well, no doubt. Implementation is probably the biggest issue here. And so I've seen a question that popped up around the e-levy and whether Ghana can derive benefits, or what benefits Ghana can derive from the implementation of the e-levy, and what the likely drawbacks from this implementation could be for financial inclusion. I suppose this question hits it on the head, and I'm no tax expert and I'm no public sector expert. But what I feel is that I often find to get a tax reform off the ground, government has to be almost squeaky clean, because many of these policies to try and crowd in the untaxed market, or to widen the tax net, or to broaden the tax net, so to speak, it requires you only get buy-in once you have demonstrated as a government that you are running a lean ship from your side, and that you are also potentially having had a couple of years of taxes being directed predominantly at the high net worth individuals. You know, so I don't have very long-standing knowledge of Ghana specifically to know that they have done this. My feeling is that they've been very good on the expenditure side to curtail it, but I do not know, and it's not clear to me just yet, that they've gotten, you know, taxes off the ground that specifically aims itself at the high net worth individual. So the shift towards property taxes, for example, would be a classic one that I think they need to demonstrate, because this is how you tap the wealth in a society with very small, you know, contributions. You also can't over-tap that market because there's very limited high net worth individuals there. So for me, I think the inclusion and getting an e-levy on the ground is probably the right thing to do to kind of broaden the tax net. But I think perhaps the sequencing is something they should have paid more attention to. So having
actually,
demonstrated,
Yeah, so I actually wanted to give you a bit of a background to the e-levy so that you're able to give your expert advice on it. Because
great.
I think
Thank you.
it's actually the biggest topic in Ghana now.
Yes.
Is on radios, on TVs, everything. So actually what has happened over the past few years is that the government is doing everything to widen the tax net and then to bring a lot of people there. Currently, out of a population of about 30 million, we have less than 10% who are involved in direct taxes. So you have approximately 2.8 million who are involved in direct taxes. So most people are actually all into the indirect taxes. So what is actually happening is that the government then decides that the sequencing was that the government starts with social intervention. So the first social intervention is what they call the free SHS, so that the people would be able to see the benefits of paying taxes. Then the government during the COVID starts a lot of freebies and gives to the public so that they understand the importance of paying taxes. Then they move into the system and improvement of the system. So they start with what we call the Ghana card, where by June of this year, every banking transaction has to be done by the Ghana card. And they are trying to have every single identification go through the Ghana card. This will help Ghana to be able to identify every single individual. And then there's also the property identification of the. So eventually the government thought that with this precarious situation from COVID, it was an opportunity for the Ghanaian people to understand that we may not be able to add on more direct taxes, but considering the number of e-commerce, considering the number of transactions that are happening that are actually not being taxed, the government wanted to introduce this e-levy. This e-levy has been very, very unpopular among the Ghanaian populace. There is a lot of disgruntled citizenry. It's quite not welcoming for the entire, the government, and it's become a very difficult thing. From where I sit, I think communication has been a bigger problem. The government has not communicated properly to the citizenry how they should go about it. But my question here, to add to the question in terms of, because it was on financial inclusion, which was actually a very, very good question there. Most Ghanaians, as it stands, are not in the banking system. So the mobile money, which was actually, because we have an average of every single Ghanaian having about 2 phones. So there are more mobile phones in Ghana than people in Ghana. So the mobile money became one of the best instruments for people to easily transact wherever they are, through e-commerce, face-to-face, market area, everywhere. Now, the Ghanaian population are beginning to think that the e-levy is actually against financial inclusion, because immediately this discussion came up, the rate at which the transaction has dropped almost by 7 billion Ghana cedis. Because more people are beginning not to transact there, hoping that if their monies are in the e-wallets, then when this tax is implemented, they'll be affected. So the question here is that how can the government, because with this precarious situation, because we spoke about the debt to GDP, and we spoke about fiscal consolidation. Looking at all of these things, we have no other option than to pass these additional fiscal consolidation and look at other ways of internally raising funds than borrowing from the external world. How would the government be able to implement such an idea? If this is not good, what are the other alternatives?
Thanks very much, Dr. Evans. I mean, that's great color. I very much agree with you. I think that it's a bit of a conundrum. It's a catch-22 situation because there's such a big informal part of the economy. And if you do implement something like this to try and widen the tax net, you may very well risk pushing a greater share of informal transactions back. So it doesn't really, so I don't have an answer for that, but it's really going to be something that's going to be interesting to watch and monitor. Perhaps if it's done on a more gradual basis, or perhaps, like you say, there's more trust in the system, and if the communication was actually better planned, more the town halls that I see have been happening recently, if that happened last year already, then perhaps there could have been a better sentiment around it. But I think this is happening across the world. I mean, I think even South Africa is going to have to get off the ground very contentious e-transaction taxes, which currently is not, broadly implemented. So I think these countries are all sitting with a similar problem. Is there any other questions that we have left unanswered? I see there's a question about what inflation means for growth in Nigeria and Ghana. I mean, yeah, these are very real issues because as it stands, your pandemic has left many people outside of income, reliant on remittances. And so high inflation obviously does have the ability to weaken purchasing power, and as well as stimulate the credit cycle, which is, I think, also something that both Nigeria and Ghana are looking to as signs of their recoveries. But, you know, I just think the problem is that there is this widespread sensitivity now to oil, and how this really gets passed through into the cost base of the supply chain is very difficult to transcend. So my key, you know, answer really is that I just think it is likely to dampen the recovery. I don't really have an idea how sensitive growth rates are to inflation, but I would imagine that it is much higher, given the fact that the bulk of these populations are very sensitive, are very price sensitive, given low income and some of the other challenges that are being posed here. Dr. Evans, I'm not sure if there's anything you would like to add to that, perhaps.
Okay, I think it's network. Okay, are you back? Hello, Tabia, can you hear me? Right. So maybe then you might just, yes, go ahead. Yeah.
Yes. Okay. So thank you so much. So actually, for Professor Pradhan is actually a member of the Governing Council of ICCE. And Prof, thank you so much for the intervention. And Daniela, I mean, this was excellent. I think I've told you already, you should look at going back to school and giving back, paying it forward through teaching and mentoring some younger generation. It was an excellent presentation. I hope we'll be able to get some few articles out of this and then share it out there so that people who couldn't make it could learn. We want to thank all the participants for joining in and for the excellent job done, Daniele. This was actually excellent. So at this moment, I'll just call on Paul if there are any announcements. Otherwise, we draw the curtains.
Yes, thank you very much to the both of you, Daniel Marcia, our speaker for today, and of course, Dr. Ivan Gia, our moderator for today's webinar. We're very much grateful to you for spending this awesome time with us. And of course, to everyone that joined us for today's webinar. I just want to say that we are very grateful that you could make it with us. And this webinar was recorded, and so we'll make it available on the YouTube channel in the next couple of days, and we'll also share with you by email so that you can rewatch it or share with your colleagues that couldn't join us. At the same time, we have other events that we'll be hosting in the coming weeks and months. So if you can visit the ICCE website, you'll find some of these events very useful and can help you in your career progression. So on this note, we say very big thank you to all of you, and we'll come your way again soon. All right.
Thank you so much.
Thanks.
Thank you.
Thanks, everyone. Bye.
Bye.